Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2017. So the period 1st of the 1st 2017 to the 31st of the 3rd 2017. So purchases on credit, €4,500 at €8 each. Credit sales, €1,000 at €10 each. Cash sales, €1,200 at €12 each. Period 2, the 1st of the 4th 2017 to the 30th of the 6th 2017. So the purchases, €2,500 at €7 each. Credit sales, €2,011 each. Cash sales, €1,400 at €13 each. Period 3 there, 1st of the 7th 2017 to the 30th of the 9th 2017. Purchase on credit, 3,000 units at €6 each. Credit sales, 1,500 at €13 each. Cash sales, 1,800 at €10 each. The fourth quarter then, the fourth period, the 1st of the 10th 2017 to the 31st of the 12th 2017. Purchase on credit, 1,500 at €5 each. Credit sales, 1,000 units at €12 each. And cash sales, 1,200 units at €11 each. On the 1st of the 1st 2017, there was an opening stock of 5,000 units at €6 each. So, required, number 1, calculate the value of closing stock using first in, first out, otherwise known as Fifo method. Number 2, prepare the trading account for the year ending 31st of the 12th 2017. Number 3, explain how the concept of prudence applies to the valuation of closing stock. Okay, so we've a good few things to do here, but it's all very easy, don't worry. So calculate the value of closing stock using first in, first out method. So we need to look and calculate all of the purchases in both the units and in the costs. Then what we need to do is we need to tot up all of the units credit sales and the costs of the credit sales, and the exact same with cash sales. So we're going to find out all the sales then in total. Okay, so then what we're going to do is we're going to work out the opening stock, all right, as well. Okay, so then we can finally work out the closing stock in cost using the first in, first out basis. Okay, so let's go. So working out the purchases, you can see there we're just multiplying the number of units by the price per unit, all right. So we've worked out in total the purchases are 11,500 units, and the cost overall when they're multiplied by their respective cost is 79,000 units. Okay, credit sales. So we're doing the exact same thing here, multiplying each one by the number of units by the cost. Okay, the selling price that you're selling them at. Okay, so you've got your total units sold in credit sales are 5,500, and you've got your sales revenue, okay, 63,500. Cash sales then, we're doing the exact same thing, multiplying the units by the selling price in each one. Okay, so we're getting the total number of units, and then we're getting the total sales revenue there. So credit sales, cash sales. So now we can work out what the total sales are. So total sales in units are the 5,500 plus the 5,600. So that is 11,100. And then the total sales revenue in euro then, 63,500 plus 63,800 is 127,300. So that's the total sales figure. Okay. Then we're working out the opening stock, 5,000 units at €6 each. So 5,000 units, €6 each. Opening stock cost is 30,000 then. Okay. Now, here we're going to work out what is the closing stock in units. So I want you to visualize, okay, a stock room. Okay. And in that stock room, at the start of the year, they have opening stock. All right. And that opening stock is 5,000 units. Okay. Then during the year, they made purchases. Now, we worked out our purchases a couple of slides ago, right? So during the year, we're going to purchase units and add them to that 5,000 units that we already had of opening stock here, okay? And then we're going to take away the sales because we no longer have those units in our stock room then at the end of that period, okay? So that is going to be my closing stock in units. Okay, so my opening stock was 5,000 I add it to my purchases, which was my 4,500 and my 2,500 and 3,000 and 1,000, okay? So that is my 11,500. I take away my sales in units, so my sales in units were my credit sales and my cash sales added up, so 11,100. And that is then equal to my closing stock in units, which here is 5,400 units. So that is how I work out my closing stock in units. Now, part 1 is telling me calculate the value of closing stock using the first in, first out method. So we've got the amount of units that we have, right? But now we have to calculate the value of it using the Fifo method. So how are we going to do that? So Fifo means first in, first out. Therefore, these 4,500 units, right, at €8 each are going to be the first ones that we sell, okay? Meaning that the older stock is the stock that we sell first, okay? So therefore, the 5,400 closing stock of units from this question is going to comprise, all right, of the last units, first in, first out, okay? So of the last units, so the 1,500 bought from the 1st of the 10th, 2017 to the 31st of the 12th, 2017. Then we've got the 3,000 bought from the 1st of the 7th to the 30th of the 9th, okay, so the 3,000 there. And then we're going to have 900 of these 2,500 then as well. It's going to be a part of the closing stock because that 4,500 was sold first. So we're not going to have that in our warehouse. If you think about it, first in, first out, we get rid of that. If we know we only have 5,400 at the end of the period, it's going to be in this sequence that we're going to have it left, okay? So first in, first out, these were first in, so they were sold first. And then how many of these were sold? Well, 1,600 of these have been sold, but 9,000 of them are left over, okay? So that's going to look like this. So 1,500 by €5 is going to be €7,500. 3,000 units at €6 each is going to be €18,000. And then 900 units at €7 each is 6,300. So therefore, the total value of the stock then that is left at the end of the period, the closing stock, the value of it is €31,800. So that is part 1 complete. Calculate the value of the closing stock using the first in, first out method. So 31,800 units there. Okay, part 2 then. Prepare a trading account for the year ending 31st of the 12th, 2017. So a trading account is just our sales less cost of sales, opening stock plus purchases minus closing stock. So our closing stock we have just calculated here. And then we take that cost of sales figure away from our sales, and then that gives us our gross profit. So let's do that now, part 2. Prepare a trading account for the year ending 31st to 12th, 2017. So it should look like this. So our sales, we have previously worked that out. We've totted up how much all of our sales were. €127,300. Less cost of sales. So opening stock was 30,000. We add our purchases, 79,000. And we take away our closing stock, which we've just worked out, 31,800. 77,200 is our cost of sales. And then our gross profit then is €50,100. Number 3, explain how the concept of prudence applies to the valuation of closing stock. Okay, so the prudence concept states caution should be exercised when preparing financial statements. Therefore, only realised profits should be included in the accounts. However, provision should be made for all expected expenses and losses. The prudence concept ensures that profits are not overstated and losses not understated. If closing stock was overvalued, then profits would be overstated. Therefore, stocks should be valued at the lower of cost or net realisable value. Now, So it was part B of 2018. So product costing. So the following are the specifications for a job quotation received from Tully Limited. Direct materials 70 kilograms at €16 per kilogram. Direct labour hours spent in each department. Department A, Department B, and Department C. So Department A has 50 hours, Department B 120 hours, and Department C 24 hours. The monthly budgeted figures are as follows. So the budgeted overheads in Department A, we have variable €20,000, fixed €22,000, wage rate per hour €15, labour hours €500 per hour. Now you'll see there that euro sign was a mistake on the paper that year. Okay, and it did cause confusion to some students in that year, and therefore the marks given for this question, they were generous with the marks there because they had made that mistake. So general administration overheads are expected to be 55,100 for the month. Required, number 1, calculate the variable and fixed overhead absorption rates for each department in direct labour hours. 2, calculate the administration overhead absorption rate in direct labour hours. 3, calculate the selling price if the profit is set at 25% of selling price. And 4, outline the role of the management accountant within an organisation. Okay, so let's look at part 1. Calculate the variable and fixed overhead absorption rates for each department in direct labour hours. Okay, so here are the direct labour hours, and they want to know the variable and fixed overhead absorption rates for each using the labour hours. So let's do the variable costs. So 20,000 divided by 500 labour hours is €40 variable cost per hour. Department B, €18,000 divided by 1,000 labour hours is €18 variable cost per hour. And Department C, €21,000 variable costs divided by 1,400 labour hours is equal to €15 variable cost per hour. Now, with the fixed overheads then, €22,000 divided by 500 hours is equal to €44 variable cost, fixed cost per hour. Department B, €23,000 divided by 1,000 hours is equal to 23, and that should say fixed cost per hour, so FC per hour. And then Department C, €42,000 divided by 1,400 labour hours is equal to €30, and that should say fixed cost per hour. Okay, part 2 of that question then. Calculate the administration overhead absorption rate in direct One, two, three. Okay, so this video is 1, 2, 3. This video is on job costing, and you'll see there we're going to start with the 2018 job costing question. The 2019 job costing question will be in the videos with over apportionment. Alright, so let's get started. 2018. So part B of 2018 was about job costing. So the following are the specifications for a job quotation received from Tully Limited. So direct materials 70 kgs at €16 per kg. Direct labour hours spent in each department. Department A, 50 hours. Department B, 120 hours. Department C, 24 hours. The monthly budgeted figures are as follows. So in Department A, the variable cost 20,000, the fixed cost 22,000, the wage rate per hour is €15 per hour, and those 500 labour hours. Now you'll notice here that euro sign should not be there. All right, that was a mistake in the paper, and don't worry, mistakes in the paper like that, they will be very lenient then when it comes to the marking scheme. They'll be generous enough with the marks if there's any huge mistakes that they've made that might confuse you in the paper. So Department B there, €18,000 variable costs, €23,000 fixed costs, €26 wage rate per hour, and 1,000 labour hours. In Department C, there was €21,000 variable costs, €42,000 fixed costs, €34 wage rate per hour, and then 1,400 labour hours. General administration overheads are expected to be 55,100 for the month. So what is required here? So number one, calculate the variable and fixed overhead absorption rates for each department in direct labour hours. Number two, calculate the administration overhead absorption rate in direct labour hours. Number three, calculate the selling price of the job if the profit is set at 25% of selling price. And number four, outline the role of the management accountant within an organisation. Okay, so let's get started. Number one. So first of all, we'll do the variable overhead absorption rates. So Department A, €20,000 divided by 500 hours is equal to €40 variable cost per hour. Department B, we've got €18,000 divided by the 100,000 labour hours, and that is €18 variable cost per hour. And Department C, we've got €21,000 divided by 1,400 labour hours is equal to €15 variable cost per hour. Fixed cost then. We have the fixed cost here, €22,000 divided by 500 hours is equal to 44 fixed costs per hour. €23,000 divided by 1,000 hours is equal to €23 fixed cost per hour. Department C, €42,000 divided by 1,400 hours is equal to €30 fixed cost per hour. Okay, part two then asks us to calculate the administration overhead absorption rate in direct labour hours. Okay, so we have the labour hours here, and we have general administration overheads are expected to be €55,100 for the month. Okay, now remember, these are hours, not euros, okay? So pretend that euro sign is not there, okay? So what we have to do is tot up how many hours is here in total. So in total, we've got 2,900 hours. So if you've got 2,900 hours and the general admin overheads are expected to be 55,100 for the month, okay, then what we'll just do is divide the 55,100 by the 2,900 hours, and that works out to be then €19 per labour hour is the general admin overhead. Okay, part three of the 2018 question then says, calculate the selling price of the job if the profit is set at 25% of selling price. Okay, now looking at the entire question here, all right, let's get calculating. So we have our direct materials, 70 kgs at €16 per kg, all right. Then what we can do is we can look at the direct labour, okay. So we have all of the hours written here, okay, and we have the wage rate per hour in each one of these. So Department A, 50 hours, and the wage rate is €15 per hour, so that's €750. Department B, 120 hours, and the wage rate is €26 per hour, so that's 3,120. And Department C, we have 24 hours, and when we multiply that by the wage rate per hour, €34, we get €816. Okay, so we'll add them all up to get the total labour cost there. So that's €4,686. Now we'll get the variable overhead. Okay, so what we're going to do, all right, is multiply the hours by the rate that we have worked out there in part one. So the variable overhead for Department A was €40 per hour, so that's €2,000. Department B, 120 hours at €18 per hour. So you also got that in part A. All right, in part one, 2,160. And Department C, we have 24 hours multiplied by €15 per hour, also worked out in part one here. So that is €360 there. Tot them all up, and our variable overheads in total, €4,520. Next then we have the fixed overheads. So remember, we worked out the fixed overheads as well. Okay, so the 22, all of these here divided by the amount of hours, and then that's what the rate was per hour there. So Department A, 50 hours multiplied by €44 per hour, €2,200. Department B, 120 hours multiplied by €23 per hour, €2,760. And Department C, 24 hours by €30 per hour, €720. Tot them all up, and that gives us €5,680. Now, general admin overheads. We remember that we worked out what the general overhead rate was here for our admin. It was €19 per hour. Where am I getting this 194 hours from? Well, I'm adding my 50 hours in Department A, my 120 in Department B, and my 24 in Department C. So that equals 194 hours in total. So 194 hours multiplied by €19 per hour, €3,686. They are all of my costs, okay? When I tot them all together, that is my total cost, €19,692, okay? So that is 75% of the selling price. How did I get that from? Where did I get that figure from? Well, it says calculate the selling price of the job if the profit is set at 25% of the selling price. So if the selling price is 100% and the profit is 25%, the total cost must be 75%. So 19,692 is equal to 75%, therefore 25% is 6,564, and the selling price 100% is €26,256. So the theory part then, part 4, outline the role of the management accountant within an organisation. So the management accountant is a key member of the organisation's management team who makes a vital contribution to the managerial functions of planning, controlling, and decision making. The management accountant is responsible for: number 1, preparing data, gathering information required for formulating plans. Number 2, recording costs and providing details of the costs of products and departments. Number 3, participation in the creation and executing of budgets. Number 4, assisting in the control of operations by comparing actual costs with budgeted costs. Number 5, providing data for decisions that require managers to select between alternative courses of action. And number 6, ensuring that relevant data is provided to managers on a timely basis and that the data is readily understandable. Finally, number 7, the valuation of closing stock, which is then used in the preparation of financial statements.